Hi, I am Brandon Willis, owner of Ranchers Insurance, an insurance agency that specializes in USDA's livestock risk protection, often called LRP. After talking to hundreds of cattle ranchers all across the nation, I have decided to take the most common LRP questions and areas of confusion and address them in a short video. LRP is a great program, but it's important to understand the basics so there are no surprises. Now, the usual disclaimer. I cannot possibly lay out all of the rules in this short video, and the rules can change over time. So you should read the policy for all the details. Finally, if something I say is confusing, please reach out to your agent or myself to avoid any surprises. To make it easy, I will cover potential issues chronologically from signing up for LRP to getting paid a claim. Okay, the first step with LRP is filling out the application correctly and putting the correct name on the application. The name on the application needs to be the person or entity that owns the insured cattle. For example, if Brandon Willis LLC is on the LRP application, the documents used to prove livestock ownership need to be under Brandon Willis LLC, not just Brandon Willis. Also, some operations have a landholding entity and an entity that owns the cattle. Make sure you list the right entity on the application. Next, as a general rule, you need to own the insured cattle at the time you write an LRP endorsement. Now, there is an exception for unborn livestock, and it allows you to insure unborn calves provided you have an ownership interest in pregnant cows that will have the unborn calves that you insured. Let's talk about a few examples to illustrate this. If you are planning on purchasing some cattle to graze on your place in the summer and you'll sell them in the fall, you cannot have an LRP endorsement on those cattle until you own them. In other words, you can't buy a little bit in advance when you look at the price and it seems pretty good. You need to wait till you own them. But if you are a cow-calf producer, you have pregnant cows, then you could purchase LRP prior to the birth of those calves because you own pregnant cows. That provides you some flexibility if you look at the market and want to insure in advance. Now, let's assume you have LRP coverage established. Let's talk about when you can sell or dispose of your livestock. It's simple. There's a 60-day rule. If you dispose of or sell your livestock more than 60 days ahead of the expiration of your LRP contract, then you lose your ownership interest in the insured livestock, which is necessary for you to receive an LRP indemnity. Beyond that, it doesn't matter when you sell. You can sell after the contract ends, and you can even retain ownership. If you unexpectedly need to sell your cattle more than 60 days before your LRP contract ends, work with your insurance agent to get the policy transferred to the buyer so the LRP endorsement stays in force. Also, historically, USDA has waived that 60-day rule during severe drought conditions. To illustrate how the 60-day rule works, let's provide an example or two. If your LRP endorsement is going to end the end of June, then you do not want to sell those cattle more than 60 days before the end of June. So really, in April, March, that time frame, you want to avoid selling them unless you're okay with your LRP contract not covering those cattle. Another problem that could impact an LRP payment is not having as many livestock at the end of the LRP contract as you insured at the beginning due to death losses. The simple rule is that you need to have proof of the number of cattle that you insured at the end of the LRP contract. So, if you owned and insured 100 cattle, but 5 died before the LRP contract ends, you're only going to get paid on 95, unless you provided a written notice of their death within 72 hours from when you discovered they died. This does apply to the unborn category as well, and additional documentation may be required for unborn cattle. Reporting livestock losses doesn't need to be complicated. If you have further questions, reach out to your agent. Here's what I often suggest to my clients. At times, it's easier not to insure every single calf you have if you don't want to be worried about reporting losses. So perhaps if you have 200 head, but you expect a little bit of mortality losses, don't insure the full 200 head. While it's rare, if your livestock are seized, quarantined, or destroyed by any government order, you must also provide 72 hours notice. Now let's talk about a few key issues at the end of your LRP contract. When you signed up for your LRP endorsement, you estimated the weight of the cattle at the end of the contract. In other words, what they will weigh when the contract ends. What if the cattle are not the weight that you thought they would be when it ends? The rule isn't complicated. The weight of the cattle, either when the livestock were sold or when the LRP contract ended, whichever is earliest, need to exceed the minimum target weight, unless one can demonstrate extraordinary circumstances such as drought or lack of feed cause them to be underweight. What is a minimum target weight? It is not the weight that you put on the LRP endorsement. In other words, it's not what you estimated they would weigh at the end of the LRP endorsement. USDA's LRP has two weight classes. The first class is for those cattle that are 599 pounds or less. The second class is 600 pounds to 1,000 pounds. And so the rule is simple. That ending weight of your cattle, the actual ending weight, not what you estimated they would be, but the actual ending weight needs to be in the same category as what you estimated they would be. Let me do a few examples to illustrate this. If you estimated that at the end of your LRP contract, your calves would weigh 550 pounds, and they actually only weighed 500 pounds. That's actually okay because they are in the same weight class. If you estimated they would weigh 800 pounds, but they ended up only weighing 750 pounds, that's also okay because you're in the same weight class. The problem would be if you estimated they would weigh 615 pounds and they ended up weighing 550 pounds. You've crossed from the 600 pound to 1,000 pound weight class down to the 599 pound and below weight class. And if that happens, your LRP indemnity can be reduced. Now, let's discuss how your potential LRP indemnity, and LRP indemnity is just what LRP will pay you if the price falls, is determined. This may be the most confusing issue for producers. When you establish LRP coverage, you start with a coverage price, which could be called a price floor, because if the cash market at the end of your LRP contract falls below the coverage price, then you receive an indemnity. When you established LRP coverage, your coverage was based on the feeder cattle futures, an estimate of what cattle prices might be in the future. Now, the contract is ended, and we need to determine if you are due a payment. So we need to determine the cattle prices at the end of the contract. We want to compare the price floor that you set or the coverage you set with where the actual cash market is at the time your LRP contract expires. At the end of the LRP contract, the price used to settle the contract or to see if you are due an indemnity is based on the feeder cattle index, at times with some small adjustments to it. What is a feeder cattle index? In simple terms, it's a representation of the cash market for cattle. The feeder cattle index is an average of feeder cattle prices in 12 key feeder cattle states. It utilizes USDA's Agricultural Marketing Service feeder cattle reports to create an index that provides publicly available information on the feeder cattle market. The majority of these reports are auction trade results, and the rest are direct trade, internet auction, or video auction results. At times, producers tell me that their understanding is that LRP settles against the producer's sale price. In other words, what the producer received for the cattle that had been insured. While there should be a reasonable correlation between the feeder cattle index and your sale price is irrelevant for LRP purposes. If this doesn't make sense, call me so I can explain it. I would also suggest you quickly look up the feeder cattle index on the internet to see where it is today. An example of this, just to illustrate how this works, if you lock in a coverage price of $2 for your feeder cattle, at the end of that contract, the feeder cattle index is $195, then you would be due the difference between what you covered and what the feeder cattle index is, minus any premium that you might owe. However, if you sold them for $190, which is less than the feeder cattle index, that is irrelevant for calculating LRP. We're still going to use the feeder cattle index. In another video, I will explain how USDA makes adjustments to the prices, but be aware that depending on what you insured, steers, heifers, dairy, Brahman, unborn, etc., there can be adjustments made to the feeder cattle index when it's used to settle your contract. If the end date of your LRP contract is on a Saturday, Sunday, or federal holiday, or if for any other reason the relevant report is not available for that day or any other day of the ending period, then the actual ending value will be based on the most recent reports made prior to that date. Now, let's assume that you are eligible for an LRP payment. What will be required? First, you'll need to have proof that you own the number of head insured and their weight and type. What documents are acceptable for an LRP payment to be processed? Documents deemed sufficient to support verification of ownership include, but are not limited to, bills of sale, financing and credit documents secured by the covered livestock, or certified written statements from third parties, such as feed suppliers or veterinarians who have visited the farm or ranch, who visually identify the livestock listed on the specific coverage endorsement and can attest to ownership of the identified livestock. If livestock purchase agreements are provided to verify ownership, they must have a date of delivery or pickup before the start of the insurance period. Documents verifying the sale of livestock during the insurance period must show the seller, purchaser, date sold, weight, and the weight of the livestock sold. A few final rules. You need to sign the claims form within 60 days from the end date of the LRP contract to ensure that you are eligible for payment. You do want to retain any records for the next 3 years after the contract ends. You cannot have duplicative insurance under another USDA program on the same livestock. As of today, what that really means is you can't insure the same livestock at the same time under an LRP contract, and you cannot have those livestock insured under a livestock gross margin policy as well. Thanks for watching the video. If you're looking for a team of experts that specialize in livestock risk protection, call the number on the screen. We work with producers of all sizes from all over the nation. We would love to work with you and help you have a great experience with LRP. If you want to learn a little more or to see daily LRP prices, go to the nation's best LRP website, lrpcalculator.com. Thanks for taking the time to watch this video.